Hello there, ladies and gentlemen. Karaoke Andy here with part 2 of the beginner series, From Curious to Confident. And today we're going to talk about the hidden cost of trading. So for this purpose, believe it or not, I made a little presentation because it's easier to walk you through. So bear with me. So here's the thing, when you go to social media and you see all the fake gurus with their Lamborghini pictures and the 20-somethings, telling you how much they made and how much they locked in and how much they got paid out and celebrating each other, yeah. So they're all telling you how they became rich and millionaires at age 20, right? But nobody tells you actually about the cost of trading. So how much does it cost to trade? It's not for free. Quite the opposite. Brokers and prop firms, they make a lot of money. So let's fix that. Let's dive in. Let's talk about prop firms first. Because a lot of you guys, I know for you, you think it's an attractive thing. So instead of depositing 10,000 euros into a broker account, why not buy a prop firm challenge for a fraction of the cost, right? So there's at first glance, or not at all, there's nothing wrong with that. But you have to understand what a prop firm actually is. A prop firm is not a broker. It's everybody, you and I, we can just go with our ID and maybe a clean criminal history, whatever the requirements are in your jurisdiction, go to the company registration office and we can just open up a prop firm. That's it. We just call ourselves a prop firm. And the way how a prop firm works is it isn't a broker, it's a trading evaluation company. They evaluate your trading capabilities and they charge a fee for that. So you trade in a simulated environment, basically on a sim account. You paper trade, means all the same thing. And you pass challenges. And once you pass those challenges, you might be eligible to payouts, right? So, but you have to understand that their whole business model is charging for the evaluation, the entry fees. And once you fail, you can buy a reset. So you're charged again. Entry fees and resets. That's their main revenue. That goes into a big pot. And those who pass the challenges and actually are eligible to payouts, guess what? They continue to trade on a simulated environment. On the demo account, they continue to paper trade and they will be paid out of that pot of collected challenge fees and resets. So actually, it's a brilliant business idea. You know already from the first video, that 90% of retail traders, they lose money. So now add some tight rules like daily drawdown limits, weekend bans, no news trading, and they push the odds further in their favor. That's just it. So you have to understand with who you get into bed with. Prop firms are not evil. But they're basically casinos with better marketing. The house always gets paid first. So this is FTMO. And there you see here, you can choose different account sizes. Let's say you go for the $50,000 account. You can also change the currency. You can make that euros. And then you have basically a 2-step verification, right? And if you pass that, then you're eligible for payouts. So that 50,000 account costs you 345 euros. You have to generate a profit target. You have to generate profits of $5,000 in step 1 and then 2.5 in step 2. After that, you get payouts. Not 100%, but there will be a profit split, which is really just a deductible, right, for them. So they say you keep 80% of the profits. Remember, you're not trading the real market. It's a simulated environment. You get paid out of the pot of collected challenge fees and resets fees. Yeah. So the 20% really is a deductible on the payouts. Yeah. So you have to trade with a prop firm differently from a broker. But that's for another video when we talk about risk management. For today, just so you understand the differences. So now, what is a broker? A broker is basically a bank, a specialized bank. It's a regulated middleman, yeah, that lets you buy and sell financial instruments. Yeah? So we're based in Europe here. So for the purpose of this video, I will focus on CFDs. And usually when you talk about trading, it's either one of those two, futures or CFDs. Yeah? So we're focusing here on CFDs. They're cheaper to start, easier to scale. But to give you some context, most of the trading communities and trading educators, they're based in the US. They will inevitably have to use futures because CFDs are banned in the US. Honestly, for good reason. A couple of years ago, you could lose more money than you would deposit with CFDs. So you could end up owing the broker money. Those days are over. If you choose a broker with negative balance protection, then you can't owe the broker money, and it's the easier product. But depends. There are differences. We just focus on CFDs here. So now let's talk about the costs. And before I do that, let me have a sip. Usually it's spread and fees. So what the heck is the spread? So you see here, this here is what you see when you go to a currency exchange place. Maybe when you're traveling, right? So you're from Europe, you have euros, you travel to the US and you want to exchange your euros to the local currency, which is the US dollar. And then you go to an exchange place and they give you two prices there, usually on some bulletin or on some screen, right? They say we buy your euros for 29.52 and we sell for 34.16 or whatever, right? So buy, sell, or bid, ask, it's the same. You can use it synonymously. The difference between those two is the spread, and that's what the broker charges, right? So the exchange place, they might tell you, yeah, 0 fees, but how the hell do they make money? Yeah, with the spread, right? So they basically buy your euros cheaper and than the market value, and that's how they make money. Yeah. So brokers do the same. Yeah? Whether you trade currencies, crypto, commodities, precious metals, or stock indices like I do, there will be always a bid and a ask price, right? And no matter if you win or lose, that's what you have to pay to the broker. Yeah? So most CFD brokers, they don't charge additional fees. Some do, but mostly they are built into the spread. So that's really all you pay, right? So they don't charge extra commissions. You know, prop firms, there's, remember, you don't trade the real markets, you trade a simulated environment. There will also be spreads, but for them, that's just another deductible to your payout, you understand? So part of the simulation are spreads, and they just deduct that further, yeah, from your payout. All right, so let's say you're trading the DAX at €5 a point. Yeah, so DAX is now at 25,000. You put on a long position at €5 a point. That's your stake size. The DAX goes 1 point in your favor. Yeah, your €5 in plus goes 10 points in your favor, €50 in plus. Yeah, so, and if the broker charges a 1 point spread, whether you win or lose, that trade will cost you €5. Yeah? If the broker charges you a 1.5 point spread, that's already €7.50. Yeah? With every single trade, whether you win or lose. Yeah? So I'm showing you now two brokers side by side. You can see the spread changing constantly, because there's a difference between variable and fixed spreads, and that's an important difference. So most CFD brokers have variable spreads, and they change randomly. So if you trade the DAX, sometimes you pay a 0.8 spread, sometimes a 1 point spread, sometimes a 3 point spread. It just changes randomly, or with volatility. And the best way to illustrate that is by showing you a video. So here I have recorded two brokers side by side. One is XM and one is IC Markets. And you see here, for example, Germany 40 cash, that's the DAX. Yeah? You see bid and ask. And you see also here the another broker, DE40, that's the DAX here, right? So let's pause this video. And now you see here that the left broker is charging a 2 point spread, right? Here the difference between bid and ask, 24,250.24 and 24,252.24 is 2 points. Now the right broker is charging you only a 0.5 point spread. Yeah? So what does that mean? If you trade the DAX at €5 a point, the same trade with the left broker will cost you €10. Yeah? And with the right broker here, this will cost you $2.50. Yeah? It's a big difference. So now let's look at the euro dollar here. So 1.16930, 1.16938. So that's actually pips. Yeah, the difference is 8. I will, in a later video, I will explain to you what that means. Pips in Forex versus points in stock indices. Let's just go for the difference here, is 8. So now let's let run a little bit. Go a little bit forward. So, and here, now you see that the difference, just a little bit later in the video, is not 8, it's suddenly 9. Yeah? So, and that's the variable spread. And that's not even fluctuating so much. You know, some brokers are fluctuating really crazy. So, but that's when you trade with a broker with variable spreads. You don't know actually what you end up paying. So the only way to approximate that would be if you record a video when the markets are open, and then maybe go for some instruments that you're interested in. Here's a mixture of currencies, stock indices, there is oil, there is silver, and there is gold, right? So, and then just watch it maybe and in a quarter speed and note down the maximum. Or you could go for a broker who actually offers you fixed spreads. So this is Trade Nation. They are a fixed spread broker, and that has a great advantage that you don't need to worry about. The difference is always the same. So now this is actually the live markets, right? While I'm recording that. So how do we stop that? Yeah, we stop that by taking a screenshot. So, and here you can see the screenshots that I just took. So you see here Germany 40, the DAX is a 1 point spread. And that will just stay the same because it's fixed, right? So, same for all the other instruments. All right. Let's move on. Now, you need to understand leverage. When you trade with a broker in Europe, then leverage is capped at 30 to 1. If you go outside of the EU, maybe offshore, maybe to Australia, you get higher leverage. Sometimes 200 to 1, sometimes even higher than that. I trade with 200 to 1. So leverage is very powerful, but you must know what that is and how that works, right? So leverage doesn't mean just because I use 200 leverage, 200 to 1, 200 times leverage, it doesn't mean that I'm risking 200 times as much or that I'm making 200 times as much. I can choose with a CFD broker, I can choose my stake size freely. So again, the DAX, here, this is a trading ticket with Trade Nation. That's 5 euros a point. Yeah? I can put there 1 euro a point. I can put there 100 euro a point. Yeah? 100 euro a point, that's already high stakes trading. 1, 2, 3 euros a point, that's probably where you want to trade as a beginner. And maybe even, if you trade for a while, 3, 4, 5 euros a point, that's where you can make a comfortable living with. Yeah? So wait for the video where I talk about sizing, risk management, and all of that. Right now, I just want to explain to you how margin works. Yeah. So in this case, that's 5 euros a point stake size. Okay. So DAX goes up 1 point in your favor. You would close out. You would make 5 euros, right? 10 points in your favor, 50, and so forth. Yeah? So now, how does leverage work? So imagine you buy every stock in the DAX. Yeah? The DAX is basically, it's a stock index. There are 40 stocks in there, right? If you buy every single one of that, of course, with the correct weights, yeah? But just to maybe oversimplify it, so you buy every stock in there, and the total position, the total value of your 40 stocks there is where DAX is actually trading at. Something like 24,138 euros. Yeah? So, now you own those 40 stocks. Now the DAX goes up 1 point, and then you sell those 40 stocks. When I say 40 stocks, I mean, in the correct weights, but don't want to overcomplicate it. So you sell all those stocks, and let's say you wouldn't pay commissions, spreads, or whatever. What would you have earned? You would have earned €1. So again, you buy all the stocks that make the DAX. Their combined value is where the DAX trades at. DAX goes up 1 point, you sell them all, you make €1. So without leverage, a 1 point move earns €1. So with leverage, the exposure multiplies. So with 30 to 1 leverage, you just have more exposure, but your risk per point stays whatever you set it to, right? So you can still trade the DAX at €1 a point. So if it goes 1 point up and you close out, you make €1. So what the heck do you need leverage for? So that's the thing. If you want to put on a position with a broker, you need to deposit enough money to do so. So it's like a bank account. It's your money. You can put it there. You can withdraw it. But to open a position, you need to have enough money in there. And enough money, that's what we call margin, right? So without leverage, to open up a trade at €1 a point in the DAX, the margin requirements would be pretty much where the DAX trades at, 24,138. So you have to be really rich for that. With the 30 to 1 leverage, you just need 1/30th of that. And with 200 to 1 leverage, you only need a 200th of that. So here, this is a 200 to 1 leverage broker, Trade Nation. So the margin requirement to trade the DAX at €5 a point is €604. Now let's do the math. 24,138 divided by 200. That is €1 a point times 5. We want to trade at €5 a point. And there you have it, 600C45. So again, leverage isn't dangerous. Misused leverage is. That's why it's important that before you put on a trade, wait for the video on risk management. Really. This is just to explain you, right, how that works. Okay. Now you know what it costs to trade, who's actually holding your money, and where the traps are. So I also showed you or told you about there's also futures and CFDs. They have same charts but different prices. Future video. All right. That's it for today. Thank you very much for your attention. I hope you enjoy this video series. Come join us in the exchange. We are approachable. You can talk to us. You can meet other traders. Hope to see you there. Karaoke Andi out.